ETFs, or exchange-traded funds, are one of the most powerful yet simple ways to invest your money. But what exactly are they? How do they work? And why do so many investors prefer them over stocks or mutual funds? Let's break it down step by step in the simplest possible way. What is an ETF? Imagine a basket. Inside that basket, there are many different items: apples, oranges, bananas, and grapes. Now imagine each of those fruits represents a company's stock, like Apple, Google, Amazon, and Tesla. That basket is your ETF. In other words, an ETF is a fund that holds a collection of different stocks, bonds, or other assets, and you can buy shares of that fund, just like you buy shares of a company. It's like owning a small piece of hundreds of companies at once, without having to buy each stock individually. That's the beauty of ETFs, instant diversification. How does an ETF work? When you buy one share of an ETF, you're essentially buying a piece of all the assets inside that fund. For example, let's say you invest in an ETF called S&P 500 ETF. This ETF holds shares of the 500 largest companies in the US. So by owning that one ETF, you're automatically investing in big companies like Apple, Microsoft, Amazon, and many more all at once. And just like individual stocks, ETFs trade on the stock market throughout the day. You can buy or sell them anytime the market is open. That's what makes them so flexible and attractive to investors. ETFs versus mutual funds. Many people wonder, how is an ETF different from a mutual fund? Let's make it simple. ETFs trade like stocks. You can buy and sell them anytime during the day. Mutual funds can only be bought or sold at the end of the trading day. ETFs also tend to have lower fees because most of them are passively managed, meaning they just follow an index like the S&P 500 instead of being actively managed by a fund manager. So if you want low-cost, easy-to-access, and diversified investments, ETFs are often the smarter choice. Types of ETFs. Not all ETFs are the same. Here are the main types you'll come across. Stock ETFs. These track a group of stocks. For example, the S&P 500 ETF or a tech ETF. Bond ETFs. These focus on bonds, which can provide stable income and lower risk. Commodity ETFs. These track physical assets like gold, silver, or oil. Sector ETFs. These target specific industries like healthcare, energy, or technology. International ETFs. These invest in markets outside your home country. Thematic ETFs. These focus on trends like artificial intelligence, green energy, or the metaverse. Each type of ETF has a different purpose, some for growth, some for safety, and some for diversification. Why investors love ETFs? There are several reasons why investors, from beginners to professionals, love ETFs. 1. Diversification. Instead of putting all your money into one company, you're spreading it across many companies. That reduces your risk. 2. Low cost. ETFs usually have very low management fees compared to mutual funds. 3. Liquidity. You can buy or sell ETFs anytime during the day, just like stocks. 4. Transparency. You can easily see what's inside an ETF. All the holdings are listed publicly. 5. Flexibility. ETFs can fit any investment strategy, whether you want to grow wealth, protect your capital, or generate passive income. How to invest in ETFs? Investing in ETFs is easier than you might think. Step 1. Open a brokerage account. You can use any trusted online platform like Zerodha, Grow, Robinhood, or Vanguard. Step 2. Research your ETFs. Look for ETFs that match your goals. Want long-term growth? Look for index ETFs like the S&P 500 ETF. Want stability? Consider bond ETFs. Want to invest in specific industries? Try sector ETFs. Step 3. Check the fees. Every ETF has an expense ratio, which is the annual fee you pay. The lower it is, the better. Step 4. Buy shares. Once you've chosen your ETF, simply buy it like a stock. You can start small, even a few dollars can get you started. Step 5. Hold and monitor. ETFs are designed for long-term investing. Let your money grow over time and check your investments periodically. Popular ETFs to know. Here are some popular ETFs that many investors use as starting points. SPDR S&P 500 ETF SPY tracks the top 500 U.S. companies. Vanguard Total Stock Market ETF VTI covers the entire U.S. stock market. Invesco QQQ focuses on a tech-heavy NASDAQ 100. iShares MSCI Emerging Markets ETF M gives exposure to fast-growing countries. SPDR Gold Shares GLD lets you invest in gold without buying physical gold. These are just examples. Always do your own research before investing. Risks of investing in ETFs. Even though ETFs are generally safer than buying individual stocks, they still have risks. Market risk. If the market goes down, the ETF value can drop too.